All right, so today's stream talking about ways to beat the S&P 500 by picking stocks. And one of the best ways, if not the best way, is to find a company that is a great company but has been historically overvalued, super high multiples. The market expected tons of growth with this company, and it didn't hit the unreasonable expectations of the market or the lofty expectations. Still chugging along strong, but just didn't pop off in terms of earnings, revenue, whatever the market was thinking was possible. It didn't happen, and as a result, the stock price starts to drop. Now, when a stock has enough downward momentum, it can continue to fall just for momentum's sake. Like, nothing in the fundamentals could be bad. It could be just as strong as it ever was, but it's had a history of falling in stock price. Investors see that, they lose faith, they dip out, and then eventually you find yourself with a company that is just undervalued. It's been falling for a while, and it is a great company. And this is the type of company that I'm looking at today. I've got two stocks that I'm going to be checking out, making the case for both. One new one and one that I've already invested in, but I have pretty high conviction in. So let's go ahead and see if I can move this back to the other screen. Okay, let's drop this stuff off. We're not looking at this. The first company is Lululemon. Ladies love the apparel. They're trying to move more into men's apparel. They're trying to move more internationally. Hokage, hey, what's up? Bonus stock today. Yeah, that's right. Let's look at the last 5 years. So over the last 5 years, Lululemon hit a high of $510, had a big drop, surged back up to $400, and then has dropped back down. It's sitting around $200 per share. So it's been dropping quite a bit since the peak in 2024. Even if I go back to 2021, like, it's still half the price that it was 4 years ago. Let's look back even further. So yeah, back in 2021, it had another high of 467. So down here at $200 per share. When I look at the financials and I see the revenue has been growing steadily this whole time. So we can see back in 2021, it shot up in share price because there was a lot of earnings around the horizon. It started hitting insane revenue numbers, and then those insane revenue numbers did not continue. And so it appears that a bunch of investors who thought maybe 42% revenue growth was going to be sustained hopped out. And here we are 4 years later, after 2021, when it was $470 a share. Revenue since then, so 2021 revenue was $4 billion. Now we're sitting at over $10 billion, so revenue's more than doubled. This company is looking incredibly strong. So one thing I want to point out, a couple things I always look at on the financials are the margins. I love to see high margins, especially free cash flow margin. So all of these look really strong. Another thing I like to look at is the balance sheet. I like to check how much cash and how much debt they have, because a company that has a lot of debt and a very high interest payment, it ups the risk, in my opinion. Because one thing that can really screw over a company is they require a lot of income to pay their debt. They have a bad year. They don't have as much revenue coming in, and then they have trouble servicing their debt, so they either have to pick up more debt, which raises their interest rate, or they have to issue more shares, which dilutes shareholders. So that's one thing I really look for, is cash, debt, and how much operating income do they have every year, and is it enough to conceivably cover their debt? And in this case, there is no long-term debt to speak of. Total liabilities. There's not much long-term liabilities here. $45 million. Meanwhile, they have $1.3 billion in cash, so that all looks really strong. Another thing I like to look at is their stock-based compensation. If stock-based compensation is a significant percentage of the income, that's a big red flag to me, because that a lot of times makes the free cash flow margin look better than it really is, but very small percentage. So let's go ahead and jump over to the spreadsheet really quick. So nobody saw that. Hokage, you got a little bit of a spoiler alert right there. Okay, so Lulu just a quick look at the spreadsheet. So this, I use the discounted future free cash flow to project the intrinsic value of a company. So a lot goes into this. I have to project all of the future cash flows coming in. To do that, I look at revenue projections, and then I look at past free cash flow margin. Past free cash flow margin is here, 13% for Lululemon. Past revenue growth has been 20% per year, but to get the future revenue growth, I go to the analyst. So let's pull back up stockanalysis.com forecast tab. Okay, the share price targets are all looking really strong. I always, as I skim past, I always take note. What did the analysts think as far as target share prices? And I don't really put that into my projections. I'm really just focusing on revenue. Hokage, does, just checking in, does the audio sound good? Let's see. Okay, here we go. Revenue projections from the analysts. Upper line, low teens. Average analysts, single digit, upper single digit. And then the lowest analysts, we have some losses. So I'm going to paste this into my spreadsheet. And we'll see if I may already have it in, but let me just double check. Okay. Boom. All right, we're in. Okay. So what are our current assumptions? Currently, we're assuming 13% free cash flow margin. I just pasted in the analysts low, average, and high, and we are seeing a low. That's if we lose revenue over the next 5 years, and then for years 6 through 10, they turn it around. They start increasing their revenue by 5%, and then we've got a perpetual growth rate of 3%. So if that is the case, then their current intrinsic value is $220 a share, representing a 7% upside on top of the 7.2% discount rate. Now let's talk about some of these assumptions. So free cash flow margin, 13%. I'm getting that from the past 5 years. This graph right here shows the past 5 years. The blue, the gold is my assumption going forward. We can see there's a major outlier year here in 2023. So I am going to remove that from the calculation. I'm not going to have that outlier bring down the average. I think it's a little bit more accurate to assume, we've got, okay, this is a total of 63, subtract 4%. We've got a total of 59% divided by 4. This is about 15% margin. The most recent margin is 14.5. So I am going to lean towards that. So I'm going to increase their free cash flow margin by 1.5%, which brings the lowest analyst projection up to a 20% upside. Now, another thing I'm going to adjust is the discount rate. So one thing I've decided that I'm doing a little bit different recently is I am no longer using the discount rate on Alpha Spread as they show it, because they take the risk-free rate, which is 4.28%. This is how much return you could get on a 10-year treasury. They are adding to that the equity risk premium. This is the risk you take on by investing in equities, by investing in the stock market. And because the stock market has additional risk, so you should acquire an additional return. This is that return on top of the risk-free rate. But they multiply it by beta, which is volatility of Lululemon compared to the market. So this number right now is reducing this equity risk premium. I've decided I don't want to reduce by volatility anymore. I don't see volatility as like riskiness, because I'm going to be holding for many, many years. Volatility doesn't matter to me as much. In the short term, this is a famous Bill Ackman quote. In the short term, the stock market is a voting machine. It's like a popularity contest. But in the long term, the stock market is a weighing machine. And if you hold a stock for many years, on average, you're going to get out of it what that company is really worth. So I'm not going to use this anymore. I'm just going to add these two together. So I will be increasing my risk, or I will be increasing my discount rates from now on. So from 7.2, it is now up to 8.4. This is much more conservative. You can see the numbers change quite a bit. So now if the lowest analysts are correct in their revenue assumptions, then we are currently sitting at a 7% downside. But that's what the lowest analysts. The average analysts, we're looking at a 50% upside with the additionally conservative discount rate. So the next thing I want to tackle is how likely is it that Lululemon is going to have revenue similar to what the average analyst projects. And also, I also want to look a little bit more at this sheet right here where I'm looking at red flags and green flags in the balance sheet, the income statement, and the cash flow statement. This is using Warren Buffett's red flags that he uses. He uses certain ratios in these statements to find companies that either have a strong likelihood of having a durable competitive advantage, or if the margin, say we'll take gross margin for instance. If gross margin is under 20, then that would be a red flag. It would be evidence that because this company is not able to maintain a higher gross margin, they likely do not have a durable competitive advantage. That would be a red flag. Between 20 and 40% is white, neutral, and then above 40% is a green flag. And so we've got green flags on margin. They've got no R&D. They've got no long-term debt, so they're not paying any interest. So we've got green flags there. Profit margin is at 17%. Green flag would be 20, so they're almost a green flag on profit margin. Their profits have been going up. Earnings per share has been going up. Receivables, I'm not going to be looking at. Long-term debt divided by profit, so they have zero debt. So once again, green flag. Retained earnings have been going up every year. That's a green flag. Profit and inventories going up together is a green flag. Goodwill has taken a hit. Now, this is a red flag, and we're going to get into why their goodwill has taken a hit a little bit later. And this is going to be also some reason for why the share price has dropped over the past 5 years from its peaks. So this does play a role. Debt and cash. So their total debt, which is mainly short-term debt, has been going up a bit, but cash is higher than debt, so not worried at all. This is their cash and their short-term investments. Capital expenditures, fine. Depreciation is low, that's a green flag. Adjusted current ratio is green, that means they have plenty of liquidity. Operating cash flow has been going up, that's a green flag. And shares outstanding is going down every year, which is also a green flag because it means that they are buying back shares. And they're actually buying back shares at a pretty good clip. This is, so in 2023, they bought back 1.75% of their shares, and it looks like they did about 2.5% in 2025. So those all look really strong. So now let's get back to what I mentioned earlier. I want to evaluate how likely is it that Lululemon is going to be able to hit their average analyst projections, which is about we'll say somewhere between 5 and we'll call it 7% on average revenue growth every year for the next 5 years. So first of all, let's look at the presentation, right? I like to look at their quarterly presentations, their annual presentations. Let's start with, let's see here. Okay, so their most recent quarterly presentation. Let's zoom this out a little bit. Okay, power of 3 times 2. 4 years ago, they came out with a 5-year guidance. They called it the Power of 3. They want to increase their men's apparel revenue, their women's apparel revenue, and accessories and other revenue. These are the 3 goals that they have. Oh, no, I'm sorry. I totally screwed that up. They actually have 3 categories here: product innovation, guest experience, and market expansion. They've got these 3 goals, and together they culminate in a overall revenue guidance. So for this, so they hit their first one within, like, they had a 5-year window, I believe, to hit their revenue goal, and they did it in like 2 or 3 years. So now they're already releasing their next long-term guidance. This one ends in 2026. And let me pull up exactly what they're saying they're planning to do. Okay. We are committed to delivering upon our Power of 3 times 2 revenue target of $12.5 billion in 2026 and look forward to all that lies ahead. So this statement came out at the end of 2024. They reaffirmed that they are on track for their goal of hitting this $12.5 billion. What exactly would that mean? Well, let's go to their financials. So their current revenue for 2025 is $10.5 billion. So that would mean they would be increasing their revenue by, what did we say, $2 billion, which is a pretty sizable increase. Yeah, 12.5. So that's a significant increase. that is a significant increase in revenue. It's almost 20%, I believe. So they reaffirmed it in December. They're looking pretty strong so far. Let's see, they have, okay, here's their presentation. So how are they planning to hit those revenue goals? So this kind of goes a little bit into their plan for expansion. So and it shows a little bit of some more of their different segments. So they've got a global brand. They're hitting China for one. Well, let's see. Power of 3 times 2. They've got their product innovation. They're trying to get into men's a little bit more because historically Lululemon has been targeted towards women. Guest experience, market expansion, yada, yada, yada. Okay, our international business. So they're in these companies highlighted. Their total revenue in fiscal year 2023, it was 21%. Scroll down a little bit more. We are just getting started. Okay, here we go. Okay, here's the comparison I was looking for. 2021 to 2024. So in 3 years, they increased their markets from 18 to 26. They nearly doubled their stores. They doubled their employees. In terms of revenue, they more than doubled their revenue. So what I'm seeing as far as the international growth trajectory, it looks really strong. So currently their international revenue does not make up a huge portion of their total revenue because they started in the US. That's where the bulk of their customers are currently. But if they continue to compound at this rate, which is doubling their revenue every couple of years, then this is going to end up becoming a significant percentage of their total revenue, especially if they're able to continue to expand into other markets. So 50% future potential. Their compound annual growth rate for the last 2 years has been 44%. So what I need to see out of their total revenue growth is somewhere between 5 and 7%. So as far as international goes, this is looking really, really strong, and it's going to become a bigger and bigger driver for their total revenue as time goes on. So I really like to see that. Unaided brand awareness remains one of our greatest opportunities. So I'm assuming this is number of people that are aware of their brand. So 48% brand awareness in Canada, 36% in the US, Australia, China, France, Germany, Japan. These are all pretty low percentages. So there's a lot of market that they can expand into these countries. So a lot of potential there. Early stages of growth drivers, product superiority. Okay. I've seen enough there. As far as their projections for the next fiscal year, let's look at that. I'm not sure. I can't remember exactly where they post that. Okay. Okay. Here we go. Oh, these are all conference calls. Let's back up a bit. And I went to the exact same thing. Let me go to the other item here, press release. Okay. So in terms of their 2025 outlook, their net sales is expected to increase 8.5 to 9.5% in 2025. Adjusted EBITDA, this is earnings before interest, taxes, depreciation, amortization, expected to increase 4 to 5%. So not only are they expecting their profitability to increase, they're also expecting their net sales to increase. So the 53rd week in fiscal year 24 is an approximate 2% percentage point headwind. So we actually, and this growth, and it's incorporated. So I guess we can add 2% to this in if you want to take into account the full year, but they have the extra week, so they're accounting for that extra week. So this is so far looking really strong, better than 7%, which is what we would need to see on average. They're exceeding that this year. So with that in mind, the average analyst projection is looking increasingly likely to me. So that, yes, it's possible the highest analyst projections could be correct. I tend to focus more on the average and the low, and I'm really looking somewhere in between these two scenarios because I'm not investing in a company. Oh, sorry, and oh gosh, I just realized I missed a ton of your messages. My bad. I know you explained it when you say 7.2% discount rate return per year. Is that correct? Plus one-time 20% upside, assuming earnings and revenue growth is as expected. What is the expected stock price on year 6? Okay. Again, I'm sorry I missed all of these messages. I'm going to keep using this excuse. I'm new to streaming. I'm just not very good at keeping track with chat yet. So, okay. Yes, you are correct. That would have been 7.2% increase per year on average. And that is assuming that in the long term, Lulu converges on its intrinsic value. Now, in the future, at some point, it could be overvalued, it could be undervalued. So at any snapshot in time, it could be above or below its intrinsic value. Its intrinsic value could change as new information comes out. But yes, if these projections are hit, then 5 years in the future, we would see an intrinsic value of, let's go with the average analyst. So that would be $308. Let's just do this math right now. So we would have 308. We would multiply that by the increase in share price, which is 1.084, because we did increase our discount rate. And then you would raise that to the power of however many years you want to look at it. So this is a 8.4% increase, let's say for 5 years. That would mean that the share price would be $461 in 5 years. If we wanted to see 6 years, and I keep saying share price, the intrinsic value at that time would be $461. After 6 years, we'd be looking at about $500 intrinsic value. And, again, the actual share price is going to oscillate above and below the intrinsic value. And also, I should also say, I keep saying this is the intrinsic value. This is my projected intrinsic value. So some of these assumptions could be off base. The information could be outdated. There's just tons of things that can change this calculation. But the best I can do at this time is to come up with a reasonable expectation for future growth. And based on my calculations, why is that changing things? Anyway, need to look into that. I must have had some equation where I was taking these into account for somewhere, these cells into account somewhere below. So anyway, I hope that answered your question, your first question of you would take the intrinsic value today, which if the analysts are correct, 308, and then you would use a compound annual growth rate of 8.4% to see what the share price would be, or the intrinsic value would be in the future. Okay, next question. If 205 plus 20% is market is very unpredictable, plus management should be trustworthy. Yes. Oh yeah, that's why I said assuming everything goes as assumptions. And sorry, spamming with questions. Hey, no need to apologize. I appreciate you asking questions. I appreciate you putting comments in the chat. You're the only one chatting, man. So you've got 100% of the spotlight here. I'm happy to answer any questions you have. Seriously. Okay, good revenue increase. Expectation plus market cap is $24 billion now, a little more than twice the revenue. Not bad. Yep. Also, what do you think about assets like silver and copper, considering research happening on using copper for solar panels? Hey, that's an interesting concept right there. That could be a decent investing thesis. I am not researched on that, so I can't comment on how strong of an investment that would be. As a concept, I like solar panels, and as a concept, I know that the efficacy of solar is held back to some extent by how good our batteries are. I hear things that batteries are getting better and better, so just in general, I feel like solar is going to become more and more efficient, more and better and better investment as time goes on. But investing in copper, that's an interesting concept. Okay. Also, things like uranium because of micronuclear energy production, nuclear energy in Moon ERC. I'm not sure what you mean by that, but hey, I'm a big fan of nuclear. I've looked into trying to invest in fusion because I'm not sure how far out it is, but I think it's really cool. I personally think that it is going to be the future of energy to a large extent. A big portion of our energy, I think, is going to be nuclear again in the future, and it's going to be fusion. However, it's really hard to invest directly into fusion. From what I could tell, it seems like the majority of the opportunities to invest, you have to invest in a larger company that has a stake in it. So it's been a while since I looked into that, and so I can't remember some of the companies, but yeah, I mean, I'm a fan of fusion. So uranium, I think it's going to phase out personally, but in saying that, it's hard to know what the timeline is on fusion. So okay. Oh, etc. Not ERC. Silver is currently used in solar panels. Copper could be the next replacement because they're abundant compared to silver. Hey, interesting. I was not aware of that. I'm going to have to look into that one, man. Okay. So, back to Lulu. So I've got the analyst projections for roughly, we'll say 7% revenue increases over the next 5 years. I'm assuming 5% revenue increases over years 6 through 10, which would represent a slowdown. If Lululemon is successfully able to branch out into these other countries and they continue to compound their revenue growth by 44% or even some smaller fraction of that, then we could see their revenue growth actually accelerate going into years 6 through 10 and even further out than that. But again, I like to stay as conservative as possible when I make these projections. I'm trying to make projections that I feel confident Lulu can beat. And if the intrinsic value based on those super conservative projections still looks attractive, then it becomes a good investment in my mind. So what I see is low analyst projections giving me an intrinsic value of 190, representing a pretty small downside. And I think Lululemon is going to beat these projections. So I like Lululemon. I'm going to be investing this week $100 into Lululemon. I think it's a strong investment, a company that is really profitable, strong margins, no debt, high quality product. They have pricing power. Lululemon is expensive, but people still buy it because they love the brand and they love the quality of the product. So it to me seems like a great investment. I invest in a different company every week. This week it goes to Lululemon. And then one bonus company that I want to look at, a company that I have already invested in that's just been continually beat up since I invested in it. And actually, I'm going to take this moment to actually bring up my public YouTube portfolio so we can review the portfolio. Okay. So here we are. The public YouTube portfolio. Where's all the information on it? I've got the screen compressed, so it's showing things a little bit differently than what I'm used to. Okay, here we go. Currently, we have a money-weighted rate of return of 13.9%. I would like to, I haven't done this before on stream. I didn't actually realize this was a tool until recently, but I can view my performance next to popular benchmarks. So let's click on that. My portfolio is in the white. The current benchmarks that it just automatically compares me to is Vanguard Total World and iShares Growth Core Allocation ETF. Currently beating those two benchmarks, and we can see my portfolio has a lot more volatility. Early on, it had shot way up, and then some of those companies that were doing really well came back down. We actually dropped down into second place here for a bit, and then since April, we've been on a pretty good run. We're currently beating the benchmarks. The goal is to stay ahead of the S&P 500. That's what I would like to do. So let's pull up the S&P 500. And the S&P 500 is actually even lower. So just to do a quick comparison, the YouTube public portfolio, 16.67%. S&P is 8.2%. So we're currently doubling the return of the S&P 500, which love to see. However, take it with a grain of salt because the portfolio is less than a year old. And this is a long-term investing portfolio. So it's really important that we keep that in perspective and don't get too excited about like short-term gains. Like something like this, emotionally it's nice, but I'm not trading short-term. So it's important to keep that in perspective. We're beating it right now. That could change in the future, but we're going to keep an eye on it and see how's our performance. Okay, Hokage, you're asking SMPL. SMPL is Simply Good Foods. Let's pull it up right here. Oh, actually, before I get too distracted, let me go to my portfolio and let's look at the individual companies. So we'll filter it by best to worst. We'll go down here to the bottom. So here is SMPL. It is my worst holding currently. When I bought this stock, it has dropped 28.5% since I bought it. When I bought it, it looked undervalued to me. Since then, the stock price has dropped considerably. Nothing materially has changed with my projections of this company. So it still looks so strong. So let's go ahead and pull it up on stock analysis. Or sorry, not on stock analysis. Well, yeah, okay, we'll go to stock analysis first. Simply Good Foods. Let's go to their KPIs. This is a new feature on stockanalysis.com that I've recently noticed. I love this feature. It gives you just a quick look at the company's segments, their key performance indicators. That's what KPI stands for. So if you are not aware of Simply Good Foods, this is the company behind Atkins. Now, that's their legacy revenue source. Atkins has been in decline, and I think that is one reason why the stock price has not done super well. Let me hop over to the share price in the last 5 years. Okay, so we came up in 2021, and it's just been kind of choppy ever since, and we're pretty low right now. So we're as low as we've been since 2022. Let's go to Max. So this company went public back in 2018, and it's up a bit, but it's just been flat for the last 4 years. So okay, Hokage, honestly, my portfolio matches most of your tickers because I really love the technicality. Plus 1 week delay in your video upload benefited me when stocks dropped further due to tariffs. You dog. I'm glad you benefited. Yeah, very nice. The tariffs, man. That hopefully we can move past the tariffs soon enough. We'll see. Okay, so Simply Good Foods. It's been choppy. Back to financials, we'll go to the KPIs. So this company has the Quest protein bar. I have been a consumer of Quest for a long time. I love their protein bars. So I'm happy with the quality of their product. I always look for Quest protein bars whenever I want a protein bar. So I love that. They've also added a new segment, Only What You Need. It's abbreviated to OWYN. I don't know if they say Owen. I kind of just say Owen. But yeah, it's Only What You Need, abbreviated OWYN. And it's a new segment. Fiscal year 2024, they had $29 million in revenue. So it represents a small percentage of their total. Atkins represents a relatively large portion, and it has been in decline. So this, I think, is giving investors some pause. And, that's reasonable. However, when we do the calculation, I think investors have paused too much. So let's go to SMPL. Let's kind of reset here. All right. So assuming, and we also need to add in their forecast. So let's do that as well. Forecast. As we scroll by the analyst stock price predictions, those look good. The analysts are mostly saying strong buy. Some are saying buy, some are saying hold. So a decent mix there. When we go to the revenue projections, though, this is where, I care. Okay, let's copy that. And just a quick look, the revenue projections, the upper end is double-digit revenue. 2025 is projected to do well. All high, average, and low, all analysts are saying green. And then as we go forward, it gets a little bit more moderate. It seems like the average analysts are projecting increases between 3 and 6% for the next 5 years. So let's keep that in mind. Let's paste this into the spreadsheet. Okay. So based on our initial assessment using the average free cash flow margin of the past, the average analyst projection is a 12% downside. The average analyst is a 12% upside. Now, one thing that I take into account with this company that helps out the free cash flow analysis is the margin. So I am projecting that Simply Good Foods is going to improve their margin, and I'm going to get a little bit more into this, but I'll start by saying their newer brands, Owen and Quest, they are investing more money into those. They are intentionally scaling back Atkins, and they are divesting in segments of Atkins that do not bring good margins, and they are keeping investments segments of Atkins that do have good margins. So they're pivoting their Atkins segment to stop trying to grow it and focus on profitability. So in that way, I see margins increasing. They're focusing on growth in the up and coming segments, Owen and Quest. Those are higher margin. I think I saw that Quest was 10% better margin than Atkins. So in my mind, I see their revenue and their profitability growing in the future. So the average 1.44. Let's look at the trend. Over the last 5 years, it has been trending up. We had a big 2020 outlier. This was largely due to COVID. So I'm going to disregard that year. So over the last 4 years, the average has been 44. That brings the average to about 11 for just these 4 years, and that's with the 8% here. They're increasing on average to 12. Like, they've hit 12 recently. So, I think 11.4 is fine. I could see myself adding 1 percentage point to bring it up to 12.4 because I don't see their revenue dropping lower than what it is now. I think their profitability. I only see their profitability increasing. I have tinkered with increasing their revenue going forward by adding a 1 into this cell. It gives them free cash flow margin growth, which matches their trend. However, I think that's a little bit aggressive. It increases, see, by making that assumption where their profitability is going to increase by 1% per year, it increases these projections quite a bit. I think it's a little bit too aggressive, so I'm going to back that off. But with these assumptions in place, with the 8.4% discount rate, which is more conservative than what Alpha Spread shows. Alpha Spread shows 7.2. Just to give you an idea, if I assumed a 7.2% discount rate, then it jumps all of these percentages up quite a bit. And when I invested initially into Simply Good Foods, I was going based on the assumption that I should be using this discount rate, which takes into account volatility or lack thereof. And since then, I've decided, like I said earlier, I want to be a little bit more conservative. I want to use a higher discount rate going forward. And even with the higher discount rate, I'm still seeing the lowest analyst projections bringing me to roughly the fair share price today. Okay. Hokage, I have a feeling Simply Good Foods could be the next BTI by the time people realize the intrinsic value the stock has done its run up. Hey, I agree. I agree 100%. I think people are overlooking this stock. I think that the legacy Atkins segment is a big reason why this company is being dragged down. That's my number one critique of this company. Okay, let's take a quick look at the Buffett supplement and see, do we have any red flags on the books? So lots of white flags. They don't have any R&D expense. They have pretty low interest expense as a percentage of operating income. It's very close to a green flag. If it was under 10%, it would be a green flag. They're at 11% gross margin. If it was 40% gross margin, then it would be a green flag. So they've got some borderline cases here on the positive. They've got a borderline profit margin. And we can see over the last 5 years, their profits have been increasing steadily. So I like to see that. Their profits have been going up. Earnings per share has been going up. They've got a green flag in terms of long-term debt. Retained earnings has been going up. Inventory and profit has been going up together. That's a green flag. Goodwill is up there. Debt has been dropping. Cash has been going up. They're pretty close together. Lots of green flags. They don't have very many capital expenditures. They don't have much depreciation. They've got plenty of liquidity, lots of cash, operating cash flow going up. Shares outstanding has been flat. So they haven't been diluting shareholders. They have not been, what's the word I'm looking for? The opposite of dilution. I'm not thinking of it. They've been holding steady, so they've got plenty of cash from their operations to fund their growth. That's what that tells me. So let's go to their financials, cash flow statement. So one thing we can do is we can compare the operating cash flow. This is the cash flow that's coming in from their core operations. They have 182 million more cash coming in than going out. In terms of investing, they've spent in the last 12 months, they've spent 278 million, 280 million on cash acquisitions. This was the only what you need acquisition. So they have been investing in their company through their cash flow. They issued 250 in long-term debt, and then they paid off 135 million. So they've already paid off over half of that bit of long-term debt that they used to pay for this. So 135. So they had 215 in their operating cash flow that year. So they didn't have quite enough to just do it 100% off their operating cash flow, but they're going to be paying off this debt really fast. And then in their financing cash flow, they're not doing anything. Oh yeah. Oh, sorry. Financing cash flow is right here. So financing cash flow, they issued a tiny bit of common stock. They bought it all back. There's nothing really to talk about as far as not really dividends. They're not buying back much stock currently. They are really just investing in some inorganic growth by acquiring other brands. So the next thing I want to look at, how much are their other segments increasing right now? How much are they projected to increase in the future? So I want to try to build a story for myself. Like, is it likely that Simply Good Foods is going to surpass the average analyst expectations? That's what I want to build that story and see how likely that is. Hokage says opposite of share dilution is share buyback. Yes, that's not the word I'm looking for though. Or reverse stock split. Yeah, if they do a reverse stock split, that's also good. Oh wait, no, you'd rather see a stock split than a reverse stock split, because if you have a stock split, it means the share price has appreciated so much that they feel, investors who are buying whole shares. Nowadays you can buy partial shares, but my understanding is in the past, whenever a single stock was so expensive, it was cost prohibitive for people to buy a single share, so they would split each share into multiple, making the individual share price cheaper. So the reverse stock split. Oh yeah, you did say negatively viewed. My bad. I didn't read close enough. So anyway, you know that. But no, the opposite of dilution. There's another word I'm trying to think of. It's not buyback. Although I agree with what you're saying. Like a share buyback, more share buybacks than issuing is the opposite of dilution. But there's a word for it. Concentration? Oh yeah, you said concentration at the same time. Yeah, in chemistry, it's increased concentration. Maybe that's what it is in investing too, man. I don't know. Increased concentration. It just gets more dense, Each stock is more dense. Okay, I don't think that's right. But in any case, now let's look at these segments. How likely is it that this company is going to be increasing in revenue? So first thing, let's look at the macro. What is the healthy snack market summary? This is important. This was my original reason for even looking at Simply Good Foods. I was thinking, Jink, show me a Coke. I haven't heard that in a while. Originally, I was thinking, I've noticed people tend to be focusing on health more. It seems like there is a trend. I see it in YouTube videos. I see more health-related YouTube videos, more health-related podcasts. Seems like people are getting more interested in health, and people are always getting more interested in convenience. People want the easy way to get healthy, and if you're already snacking, if you can just switch that out for healthy snacks, then that's just a really easy way for people to feel good about improving their health. And so Simply Good Foods fits that niche of convenient health option. Like it seems, it passes my vibe check is what I'm saying. Now, when I look at the trends, this is backing it up. The healthy snacks market in the US is expected to grow at a compound annual growth rate of 6% between 2024 and 2030. So over the next 5 years, healthy snacks is increasing faster than inflation, double the rate of inflation. That looks good. That's like kind of the baseline. So if Simply Good Foods is able to just hold on to its market share, just hold on to it, then it's going to be increasing at 6% just by maintaining. Now, if they're able to gobble up more and more market share, then they're going to be greater than 6%. I think they can. Why do I think that? Let's keep looking. Okay. We'll start here. So this is fourth quarter and full fiscal year of 2024. So why did I bring this up? In this, definitely people are interested in health. Even in my household, we focus on buying organic. Very nice. I see that happening in other major economies like India too. Hey, I think you're probably right. Currently, I don't think that Simply Good Foods has a huge international presence. So that is another way for them to grow if they branch out into the international space a little bit more. So they say that they are positioned well to deliver our strategic objectives and succeed in fiscal year 2025. Okay, here we go. They are expecting fiscal year 2025 to be in line with the company's long-term algorithm, which is a net sales growth in the 4 to 6% range and adjusted EBITDA growth slightly greater than the net sales increase. So they're expecting their profitability to increase faster than their sales growth. They're saying this is their conservative take right here, 4 to 6%. We'll call it 5. So conservatively, they're saying they are on track to hit 5% revenue growth in the long term. This is a long-term plan. This isn't just fiscal year 2025. This is their long-term plan. Now here we can look at their different segments. And I might have another slide that shows it better. Let's see. Okay, no, here we go. So this is their most recent earnings report, updating fiscal year 2025. So net sales expected to increase 8.5 to 9.5%. So in fiscal year 2025, they're hitting 9%. They're saying their long-term outlook continues to be 5% long-term. So I'm happy to use 5%, not as their perpetual growth rate, but from year 6 to 10, sure, I can see myself using 5. But net sales expected to increase 8.5 to 9.5%. Really strong growth. Let me see if I have another slide for their segments. I'm pretty sure I do. Let's see. Maybe this is it. Key messages, takeaways. Okay, yeah, outlook, fiscal year 2025. Retail for Quest. Okay, so Quest is expected to increase low double digits. We'll call it 11% revenue increasing for Quest. Quest is growing quickly. As we approach net sales of $1 billion, we remain confident in the multi-year runway for growth. So they're maintaining, they feel strong about that segment. Atkins, majority of declines driven by previously announced distribution losses at club, not repeating significant value-driving merchandising events. So this is the thing that they chose to do. They are not increasing these, they're not continuing these big merchandising events. They're not overly profitable. This was something that they were doing when they were really trying to grow the segment, but they have decided that this is not their avenue for growth. They are focusing on the other two. So they declined 13% as expected in Atkins. They are going to continue to optimize assortment for the brand, seeking more focused on a sustainable business. In the channels where they do not have space constraints, like their e-commerce, they actually grew consumption at 7% at key customer. Atkins expect Atkins to lose significant distribution during the upcoming reset at large mass retailer late summer. Gains for higher turning Quest and OWYN SKUs will offset a significant portion of these losses. So the outlook for Atkins, not good. Fiscal year 2025 retail expected to decline low double digits. So Atkins, that is sad, but it's already been overtaken by Quest. So increases in Quest are more than offsetting decreases in Atkins, and that's only going to be a greater and greater extent, because as Atkins gets smaller and smaller, it's going to, like, the same percent decrease is going to be at less magnitude. Now, OWYN is another one where they're looking really strong. So OWYN grew at 24%. The shakes retail takeaway grew 20%. The outlook is fiscal year 2025, they're expected to hit 1.45 million, in line with their midpoint, which was 140 to 150. So let's go back to their KPIs. And if we remember, what did they hit for fiscal year 2024? 29 million. And in 2025, they're already up to 145 million. So only what you need is growing like crazy. So they've got huge growth. These two together in 2025 are projected to hit, what was this, 850 million, 900 million, plus 100 million. So they're already hitting $1 billion in growth, $1 billion in revenue from these two segments. Atkins is going to be down to 500 million. So Atkins is going to be making up roughly a third of their total revenue. And so this is only going to shift more and more into the favor of Quest and Atkins, and they're only going to be focusing on the most profitable parts of Atkins. So I see their profitability increasing as a result. And yes, their revenue is not increasing as much as it could because of this anchor that is Atkins, but that anchor is only going to get comparatively smaller and smaller. So, okay, what did they say about Atkins? So I wanted to pull up their most recent quarterly report. I went to the Q&A, did a word search for Atkins. What are people saying? Okay, moving to Atkins. Consumption in the third quarter was down 13%. Okay, we are on a journey towards more focused and sustainable Atkins business. Importantly, the core SKUs of Atkins portfolio performed above category velocity benchmarks. However, the brand does have a long tail of SKUs, many of which turn at below category average levels. Therefore, our approach continues to drive towards an optimized assortment of the brand, including bringing market improved innovation like we've done with the 30-gram Atkins Strong Shake. So in channels like e-commerce, they were up by 7%. We already knew that. As an example, during upcoming resets, we expect Atkins to see significant decline. However, we will offset a majority of this with the Quest and the Only What You Need. So we already read most of that. So let's see. As we discussed last quarter, declines accelerated due to broader distribution losses at a key customer. These two drivers accounted for most of the Q3 decline. Yeah, okay, so we've already read all of that. So I see Atkins becoming a little bit more, even though it's shrinking, it should be more profitable as time goes on. So let's go back to the spreadsheet. Let's see here. Dashboard. All right. So with that in mind, buffing the margin by 1%, I don't see that as out of the question. With the increased discount rate, the average analysts, the lowest analyst projections with a 5% growth in revenue in years 6 through 10 and a 3% perpetual growth rate puts us at about the intrinsic value right now. So if the lowest analysts are correct, then we've got essentially no downside. We're on track to make 8.4% for the next 5 years, we'll say. If the average analyst is correct, we've got a 22% upside on top of our 8.4% going forward. And then if the high analyst is correct, then we've got a 50% upside. So in my mind, I'm still happy holding on to Simply Good Foods. I don't think I'm in a position where I want to put more money into it at this time. Although, we do have another earnings report coming out. When is the next one? I might check back in the next earnings report and decide if I want to put a little bit more money in or not as I get some more information. I don't like to invest in a company right before earnings reports on average. However, I am breaking that rule to some extent with Lululemon because I'm pretty sure they have an earnings report coming out in early September. But This one just looked so good. There's just such a good upside. The average analyst would put me at a 50% upside, so I'm going to make an exception for Lululemon. Okay. So yeah, that's pretty much all I've got for today. Hokage, if you have a company that you want me to look at, feel free to hit me in the comments. I'm happy to do a little bit of research on a company live. I do enjoy doing that, especially when my viewers have had in the past really good ideas, and you included, Hokage. So if you have anything that you're looking at yourself that you want me to comment on, I'd be happy to do that. Let's go to. Let's see. Let me pull up my. Oh, here we go. Okay, let me pull that back up. So this week we're going to put $100 into Lululemon. So I'll go ahead and do that live. Oops, did I screw that up? Let's see. At the bottom, where's the buy button? Here we go. Buy $100. $100 every week. Okay. CCJ, says Hokage. Let's see this company. CCJ. Cameco Corporation. Start by going to the overview. What do you do with dividend? Hey, great question. So the dividend currently is just stacking up in my account. What do we have on dividends? That's a good question, actually. What do we have here? So in terms of dividends, I need to do something with it. You know, it's currently a relatively small amount, $14.58. Maybe when it hits $100, I'll just invest it in a company and I'll get just a bonus investment that week. You know, because I like to stick to the $100. You know, I want to add $100 to the portfolio every week. And I'm okay with dividends not reinvesting into the same company. It doesn't necessarily have to do that. You have Drip in your Webull app. Nothing wrong with Drip. Nothing wrong with keeping the cash. One way you can look at it is if you keep the cash separate from the investment, it removes a lot of the volatility of that investment. You know, if something goes wrong, at least you've been able to extract value from it, and that way, if you have to sell it for a loss, which would be unfortunate, but if you do, then the dividends that you earned that went into other things at least represents some mitigation to that loss. Now, if you've got a really high conviction with the company that you've invested in and you want to drip it in, hey, you know, I think generally speaking, drip is the way to go. Generally speaking, you want to continually reinvest your dividends. But, you know, I always like to make the case for other options. With this portfolio, I would say that, yeah, the main reason I'm not dripping is, that sounded bad. With this portfolio, the main reason I'm not reinvesting dividends is because of the format. I want to invest exactly $100 every week. So, okay, back to the company. CCJ. Wow. Okay, when you go to max, it looks like quite a jump recently. So okay, it's looking interesting. What is this company? Uranium. Okay, this is the uranium one you were talking about. Provides uranium for the generation of electricity. It operates through these three segments: uranium, fuel services, and Westinghouse. Exploration, mining, milling, purchase, and sale of uranium concentrate. Okay. So, yeah, people have been really into uranium lately. Dang. So, since April of 2025, it has almost doubled in share price. Man, I wish I would have thought of that one sooner. Let's see. Hey, recently their revenue has been growing quite a bit. Looks like they went through a little bit of a dry spell before that, but revenue's been going up. Let's look at Their interest expense is a low percentage of their operating income. That's good. Let's look at their... So a little bit of dilution, nothing too crazy. Free cash flow margin is looking really good lately. However, I bet, well, it's kind of jumpy. It really jumps all over the place. It was 3, 4, and then up into the 20s, -1, 20s, 8, and then 20. So very volatile free cash flow margin. So in this case, I probably should not remove the outlier in this case because it's not really an outlier. They drop down quite a bit. So okay, balance sheet, $716 million in cash. Long-term debt, about $1 billion in debt. I mean, they almost have cash to cover it, so that's looking pretty good. Not a ton of debt. Retained earnings continues to go up. Minority interest is low. Shareholder equity, $6.7 billion. Market cap is $32 billion. How are they spending their cash flow, though? Very low stock-based compensation. So operating cash flow of about $1.1 billion. They got some capital expenditures. They have repaid some debt. They pay some dividends, but it's a relatively low percentage I remember seeing. And then, so yeah. So it looks like mainly dividends. They issue a little bit of stock. They don't buy back shares. Okay. Interesting. KPIs. They got uranium growth, which has been growing quite a bit lately. Fuel services has been growing. Okay. Let's see how they look on the spreadsheet. I mean, I'll check it out. I'm assuming this is in USD. And this is a US company, right? Did I read that? Canada, a Canadian company. So it's not telling me. Normally it tells me like the currency. I guess I'm just going to assume it's USD. Anyway. Okay, CCJ. Okay, so past free cash flow margin, 15%. It looks like that is, I mean, if I use my adjusted average, I would even bring it down a little bit. But even with the 15% free cash flow margin, if we assume 5% revenue growth for the next 10 years and a 3% perpetual growth rate, then we have a major downside. So, CAD, thank you. CAD to USD. 0.73. That will change things. But not enough. Actually, it got worse. It got worse. Wait, did it really? Did I screw something up here? Something is screwed up here. I'm not sure what exactly it is. I've got a negative sign somewhere, I believe. What happened to my precious spreadsheet? Huh, that's really strange. It is CCJ, right? Yeah. Well, it's looking like something might be screwing up with my spreadsheet here, but it's looking like in terms of free cash flow, this company is a little bit overvalued. But what is the expected growth? That is a question that I have not answered yet. What do the analysts say? The analysts like it in terms of share price. The analysts all say strong buy. What is the projected? So, I mean, there's pretty good top line revenue growth projections, but I don't think that's going to be enough. You know, I tend to keep my investments pretty conservative. Like, I want to see a high upside. Okay, so after taking into account those, it did get a little bit better, but even if the highest analysts are correct, in my opinion, the upside, it just isn't there. You know, the stock price has shot up a ton. There must be lots of hype right now. You know, I'm not up to date on the latest policy, if there's been any policy changes on uranium or nuclear that could affect things. But clearly, this company is hyped right now. I don't know what's going on with the company, why it shot up so much recently, but you know, at least so far, after a quick look, to me it looks like it has shot up too much. So Hokage, what do you think? Are you plugged in to what's going on with this company? Do you know why it has shot up so much recently? Do you have any reason to believe that this company will have much higher growth than what is currently projected? So let's say if they have 40% revenue growth over the next 5 years, then that leads me to a 22% upside on my projection. So yeah, this cell. So these three are using the analyst projections. This cell is my projection, which is calculated right here. No, just something my friend is interested in, and I was surprised by the spike. It's a hell of a spike, man. It is a hell of a spike. I think it spiked too much, you know, and that's not to say that it's not going to keep going up. Hey, it might, you know, but in terms of projected free cash flow, it's not for me. Unless I learn some things about this company that makes me think it's going to have 40% revenue growth over the next 5 years, we'll see. So, all right, man. That's all I got for today. Unless you have another company you want me to look at, I'd be happy to look at one more. But other than that, that's all the content I have for today, man. Lululemon, Simply Good Foods, two strong companies. Ooh, bopped my mic here. And I won't lie, I am tempted. I am tempted to double down on Simply Good Foods. However, I do like to keep strong diversification with my companies, especially on this portfolio. When you're picking stocks, having a lot of diversification can make a big difference. So, especially if you're going with companies that have an element of risk to them. So, Calc, SoFi, Asana are a few, maybe for next video. I don't want to take up too much of your time. Hey, I appreciate it, man. I appreciate you throwing a few more companies out there. I will look into those companies, and next week, Wednesday, 7:15, I hope I see you there. And yeah, we can go over a couple of these. And then if you have a couple others that you want to look at by the time next week rolls around, let me know. Yeah, that's all I got. Until next time.